Good morning. Please, I need like 2 minutes of your attention. First of all, we have an updated version of the program online, so we had to cancel a session and to reorganize some stuff. So please check it on our website. Second, I have to turn to my bad cop role. I would definitely advise you to take your cup bottles trash back when you leave a room, because the local organizing committee is doing it at noon or just during coffee breaks, and as you get it, it's not a nice job to do. And second, if you could hurry a bit so we won't start late at each session and at each keynote, and afterwards it's just persistence. So just to turn to a more positive tone, I would like to welcome Professor Bordo, and he will be introduced by Kim Osterling from ULB.
Thank you, Jean. I had completely forgotten how to introduce Mike, so I've just decided I will just tell you what I know about him. So Mike did his PhD with Milton Friedman. I guess that's already a good start. Then Mike is known for his former grad student. So a few years ago when he was in Portugal, the Minister of Finance was his former student and the Minister of the Economy. So he now has as a former student the head of Eurostat. So he's done pretty well in terms of training. In terms of research, he's published extensively. I mean, a few years ago, Mike got elected as president of the Economic History Association, and his colleague, to present him, made a quiz. And you had to know how many published pages he had, and you could compare it to the Bible, to the Torah, and it was like a book I'd never heard of, with something like 5,000 pages. I mean, that was massive. So it's published really extensively with, I don't know how many co-authors in how many countries, but it's like the United Nations. So he's worked and is very famous for all his work on the interwar period, but also for his work on globalization, on crisis, I mean, monetary theory, and I guess he's just, he's just also very nice. So I'll ask Mike to take the floor, and I thank you for your attention.
Okay, so it's a great pleasure to be here. I've known Kim for a long time. We've been working together. In fact, Kim was a postdoc at Rutgers, and we started working together then and kind of kept up. And as you can see, he's done real well. He's like vice provost of this university. So it's a great pleasure. It's a great pleasure to be here. And I've been coming to Belgium a lot. I've been coming to Brussels, I don't know, for many years. I worked with projects at DG ECFIN, the European Union. So it's always nice to come back, and it's a great pleasure to be part of this conference and to be with all these young economists. I think this concept of young economists is great. We don't have that in the States, at least I don't think so. And I think it's a really good way to network and to get plugged into the profession and into the job market. So I'm very impressed with what I've seen. So I'm an economic historian. I'm also a monetary economist. And this is an overview paper that I did for the Economic History Association a year or so ago. And it's on a project that I've been working on. It's on financial crises and financial stability. So this is something and central banks, and these are areas that I'm working on now, and so this is, in a sense, part of ongoing research. And let's see how to do this. Okay. So what I do is I'm looking at the connection between the monetary regime or macroeconomic stability and financial stability. And I'm doing this in an historical context. And both of these things are very important. As an economic historian, I've been studying this for decades. They're very important. Macroeconomic and financial stability are very important public goods for economic growth and for development. And what I mean, just to define my terms before I get into things in detail, and for those people who aren't in macroeconomics or monetary economics, so when I talk about macroeconomic stability, I mean price stability, stability of the price level, and the stability of the real economy. And financial stability, that used to mean, traditionally, it meant preventing and managing financial crises. And by financial crises, I'm focusing on banking crises. There's a lot of literature out there on debt crises, currency crises, and they're all part of this phenomenon. But in a sense, the core crisis that we've always thought of is a banking crisis. And so that's what my main emphasis is on. And what's happened in monetary policy is that the concept of financial stability has changed. Okay, and it's now really focused on heading off systemic risk, especially the term that's used right now or in the last decade is credit-driven asset price booms. And so what I'm going to do, just to tell you, is I'm going to really focus on that, and I'm going to argue against the prevailing view out there on financial stability. So I'm sort of taking a position, but I'm building up from based on economic history. And the framework that I'm going to talk about is based on the history of exchange rate regimes and monetary policy regimes. And again, I'm going to define my terms. So when I talk about exchange rate regimes, I think in terms of 4 regimes that have sort of dominated economic history for the past 2 centuries. What's called the specie standard, which is bimetallism and gold, the gold exchange standard, which prevailed in the interwar period, the Bretton Woods adjustable peg, and the managed float. And again, I'm just giving these are the definitions. These are the titles. I'll go into them in a bit more detail, okay? And then within the exchange rate regime, you have the monetary authority. That means the central bank, or for the US before we had a central bank, the US Treasury. And they followed something called a monetary policy regime. And that means what we could today call the reaction function, central bank reaction function. It's the relationship between monetary policy tools and goals. And so when we think of tools, today we think of the interest rate, the policy rate. But 20 years ago, 30 years ago, we talked about monetary aggregates. And if we go back before that, it's qualitative and quantitative controls. And we're back to some of that today. And the objectives of central bank, what the central bank does, has changed over time. So before World War I, it was convertibility into gold. Post World War I, it became what we think of today: price stability, stability in the real economy, low unemployment, and financial stability. So these are the things. And then, and so as time has gone by, since World War I, these are the objectives which have more or less the objectives we have today. Okay. So behind that is the history of central banks. And I've done a lot of work on that. I'm still working on it. And central banks have a long history. The first modern central bank was the Riksbank in Sweden, which was established in 1667. And we had a big conference just 2 years ago in Stockholm celebrating its 350th anniversary. And then the Bank of England, established in 1694. And central banks, thinking of the model of these two, evolved from being, from helping the government finance wars and marketing the government's debt to becoming what's called a banker's bank. That is, they became banks for the other banks. And that in turn, because they were large and had the government, and basically had a government charter, then they evolved to a lender of last resort, And then in the late 19th century, they evolved to managing the gold standard. And then the 20th century, they do what we think of, which is to provide macro stability. And the learning process to establish macro stability was long and painful and nonlinear. And I have worked with Pierre Siklos, one of my colleagues from Canada, and I'm originally from Canada too, by the way. It followed a pendulum process. So it was, in a sense, the learning process was success in the 19th century to failure in the middle of the 20th century, and then success again through the Great Moderation, and then, some people say not doing so well in the Great Financial Crisis. And so the Great Moderation was viewed, at the beginning of this century, was viewed as the pinnacle of success. Okay, so this is a table which just, it shows, I don't have time to go through all the details, but basically it's a table that gives you the history of 10 important central banks, advanced country central banks, that goes back from 1668 to the last one that was founded, which was Bank of Canada in 1934. It tells you why they were set up, what were the conditions in which they were set up, and what they were supposed to do. Okay, so there's a whole story of this pendulum, which I'm going to talk about in a few minutes. Okay, and that's with respect to macro stability. Well, financial stability. Okay, so I'm talking about these two pillars that we think of in macroeconomics and policy, which is macro stability and financial stability. And so the learning process in financial stability was also long and painful. And in a sense, the story is basically one of how central banks learn to be lender of last resort and to deal with financial crises. And in a sense, it goes back to the history of the Bank of England. It took the Bank of England up until 1873, really, to learn how to be a lender of last resort and follow something called Bagehot's Rule, to lend freely, but at a penalty rate. But other countries took a long time. The US was one of the worst. We didn't really get the plot until after the Great Depression. So what happens is that the central banks learn to provide stability over a long period of time and to deal with, manage and head off financial crises. But what happens is that with the Great Depression, in a sense, this financial safety net is created. Use of lender of last resort, deposit insurance in the US. Okay, and what that did was in a sense what were called banking panics. Okay, which was the big problem in the 19th century and the 18th century. Attacks on the banking system by the public, fearful that they would not be able to convert their deposits into currency. So they morphed into what we call today a banking crisis, which is basically one where the government, the Treasury, steps in and provides a fiscal resolution. Okay. So the banking crisis problem has changed over time, and the role of the monetary authorities have changed. And also tied in with that is supervision and regulation. And that's gone through this lengthy learning process too. Okay. So what comes out of I'm giving you this big overview, and then I'm going to go back a little bit. Okay, so what comes out of this overview is that there are four key principles of, four key principles of sound policy. Okay, the first is the importance of maintaining credibility for price stability or low inflation. Okay. The second is maintaining real macro stability, so that's counter-cyclical policy. And the third one is providing a credible rules-based lender of last resort. And the fourth one, which is not just central banks, but it's related to the whole financial system, is having a sound banking structure and effective supervision and regulation of the banking system. So this is the sort of the lesson that we learned from history that really was the way we thought of how things were before the global financial crisis of 2007 and 2008. And what the global financial crisis did was it changed the perception considerably on the connection between monetary policy and financial stability. So before the global financial crisis, or the great financial crisis, most economists argued that credit-driven asset price booms, that central banks were advised not to try to prevent asset price booms and busts, but to clean up later. It's called the cleaning hypothesis. Okay, so asset price booms have always been around, but people didn't worry about them too much until this recent financial crisis. And what happened with the global financial crisis was that many people argued that credit-driven asset price booms were the key cause of the crisis. And that central banks should use their monetary policy tools to head off imbalances in advance. So this policy was called leaning against the wind, okay, LAW. And furthermore, it's been argued since the crisis that central banks should use what are called the tools of macroprudential policy, things like capital requirements, countercyclical capital requirements, loan-to-value ratios, okay, to prevent imbalances from becoming serious. So this is what is being, offered by the establishment, by the BIS, and by many central banks, by the IMF. Okay, but there are others out there, including me, who say, wait a minute, you do that, and you're conflicting with the main goals of macroeconomic policy, and you're encroaching on central bank credibility and independence. So in a sense, what this talk is about is that. It's about this debate that's going on right now across the world on the importance of financial stability and elevating financial stability, the mandate for financial stability, to the same level as the mandate for price stability. Okay? So, in a sense, what I'm arguing in this talk is that economic history can tell us a lot, okay, and can give us some insights for this ongoing policy debate. And I want to make the point that if you only look at what just happened and you devise your policy strategies for the future, okay, and you ignore the history, that you're looking for trouble, okay? In a sense, I'm making a very old argument about fighting the last war. And in Europe, you know what that argument is about. You know World War I was here, right here, okay? And the lesson from World War I is we got to build better trenches, okay? And you know what happened after that? In 1940, they came around the trenches. So it's basically that argument. I'm thinking along those lines. Okay, so what do? What's my roadmap? Is I'm going to survey the historical evolution of monetary policy and financial stability. Okay, then I'm going to look at some empirical evidence on the incidence and costs and determinants of financial crisis, and this is based on my research. Then I'm going to give a narrative, some stories. I have some little cool pictures to show you on the history of financial crises. And the last thing I'm going to do is get on this issue, this policy issue, is to look at some evidence, very simple ocular regressions. As a student of Milton Friedman, he said, look at the data first before you do anything fancy. So that's all I'm going to do on the relationship between credit booms, asset price booms, and serious banking crises. Okay. And what the takeaways that are going to come from my talk is that financial crises have many causes, including credit-driven asset price booms, and they have become more prevalent in recent decades. But there are lots of causes, and the financial crises are very heterogeneous and they're hard to classify. And that if you look at the historical record, there are two key historical episodes that stand out in the record of serious financial crises, which were linked to credit-driven asset price booms: the 1920s and 30s and the global financial crisis. And so a question that I raise is whether these two perfect storms should be grounds for permanent changes in the monetary and financial environment. Okay, and I'm basically raising some doubts whether that is really, that's the lesson we should take. And I think that there's some lessons that come from history for policymakers and historians on this subject of financial crises. So that's the overview. Are there any questions before I get into the weeds a bit? Okay, so I'm going to talk a little bit about the historical evolution of monetary and financial stability. And as I said, central banks evolved over 4 exchange rate regimes, and doing this involved learning how to do what central banks are supposed to do. And this holds both with respect to macroeconomic policy and financial stability policy. So I look at 4 regimes. The first is the classical gold standard, and I've done a lot of research on that over the years, and I guess that's what's going to get on my headstone is he worked on the classical golds, because I get phone calls, so President Trump has nominated these two characters, Moore and Kane. They're both gold standard advocates. So I get these calls, what exactly do these guys have in mind? Okay, well, they don't. If they knew this history, they wouldn't be gold standard advocates. Anyway, the gold standard did provide a credible rule. It was a gold convertibility rule. It said that you define the value of your currency in terms of a fixed weight of gold. And if you do that, you're going to have price stability, and that's all you have to do. Okay? And it's a rule that is a contingent rule. So I did a paper with Finn Kidlin a long time ago on the gold standard as a rule and said, okay, you follow this rule, and if you do so, you're going to be viewed as credible. But if some big shock comes along, like the Napoleonic Wars, you can temporarily leave the rule and you can print money and issue a lot of debt. But you can only do that if the public understands that when the emergency is over, you have to go right back to where you were before, and that can mean a big deflation and a depression. And this was the policy that the central banks in the 19th century did follow. Okay, and the US did follow it. We didn't have a central bank. We followed that after the Civil War. Okay, and the second thing that came out of the history of the gold standard in that period was how you deal with financial crises. You follow Bagehot's rule. You lend freely, okay, to a solvent but illiquid banks, okay, and you lend freely but at a penalty rate to head off moral hazard. And so if following these principles, gold convertibility and Bagehot's rule, actually the advanced countries of Europe, okay, including this one, okay, including the Bank of Belgium, they did a pretty good job. And it was a relatively successful experience, although it differed across countries. So in Europe, some countries did better. Italy, Spain, Portugal, Greece didn't do very well. They couldn't follow the rule. But the other advanced countries did. Emerging countries had a lot of trouble. Okay. So that's just an overview of the gold standard. Okay, well then what happened is the gold standard breaks down, World War I, totally wrecked. It's like Humpty Dumpty falls off the wall. And after the war, they try to pick up the pieces. But we know the story of Humpty Dumpty. You can't do it. So they create something called the gold exchange standard, which in a sense was they tried to go back to the gold standard. They wanted to get the price stability. They wanted to have the financial discipline. They wanted to have the open capital accounts associated with the gold standard. But it didn't work because most of the advanced countries got wrecked by World War I. They ran high inflation, and it was very hard to go back. So they set up a second variant of the gold standard called the gold exchange standard, where they used foreign exchange as a substitute for gold. Foreign exchange meant British pounds and US dollars. But it basically didn't work. And I can't go into all the details. It didn't work basically because the political economy had changed. And to follow the gold standard rules strictly, that meant that the only thing that mattered was the gold standard. And that if you had a serious recession or a crisis, you just followed the gold standard. And if that meant unemployment went through the roof, too bad, people could move to Australia. And that's what happened, or the US or Canada. So the rule they reestablished basically said, no, now we basically have to maintain price stability and the gold standard, but we have to also follow counter-cyclical monetary policy and try to keep unemployment down. And so this, in a sense, changed the credibility of the system. And the system broke down. And the story is, there were three big problems with the gold exchange standard called adjustment, liquidity, and confidence. Okay, and the basic problem of the system was Britain went back to gold at an overvalued parity and always ran balance of payments deficits and was always in trouble. France went back at an undervalued parity and it ran big surpluses, and this meant that, in a sense, gold was being sucked from England and other countries tied to that to France, and the US also had an overvalued. So the system became unstable. Okay, and so the way it was propped up was by central banks getting together, the central bankers getting together under the leadership of Montague Norman, governor of the Central Bank of England, Benjamin Strong at the Fed, okay, Moreau in France, and Hjalmar Schacht in Germany. Okay, and they got together and they worked out deals to keep the system going, basically to keep Britain on the gold standard. So this is the beginning of the dual mandate. Okay, but in a sense, the system blew up. And part of the problem was going on in the United States because the Federal Reserve was established in 1913 to provide financial stability. And Fed began to worry about an asset price boom, a stock market boom that began on Wall Street in the mid-20s. Okay, the Wall Street boom was actually reflecting fundamentals. This was the 20s, fantastic advances in productivity, new products. Okay, and the stock market's rising. The Fed was worried that this would lead to a bust, and following what was called the real bills doctrine, that would lead to inflation and deflation. So they headed off the boom, followed contractionary policies, and that was the beginning of the downturn that became the Great Depression. Okay, so they made a mistake on real bills. Secondly, when the Great Depression really got going, banks started failing in the US, and the Fed did not follow Bagehot's rule. It allowed the banks to fail. And that led to a really serious depression in the US, which spread to the rest of the world through the fixed exchange rate gold standard. And so the gold standard became a very big part of the problem. Okay. So the system collapsed in the 1930s, completely dead by 1936 when France left the gold standard. And the entire world, in a sense, went the globalization that had been established pre-1914 ended, by 1936. You had capital controls, increase in tariff protection, okay, and the entire international financial system and trading order totally collapsed, and we got World War II. So after the war, they created Britain and the United States, the two sort of big powers, held a conference at Bretton Woods, New Hampshire, to create a new order, international money, that would take the best of the gold standard and also have flexibility to allow countries to follow stabilizing macroeconomic policy. So it's called the Bretton Woods system. It's a compromise between fixed exchange rates and domestic macro control that you can get with floating exchange rates, but it required capital controls. And I'm not going to go through the history of the Bretton Woods system. Key thing to note is that actually the period from the, in the late 50s through the 60s was a period of really good macroeconomic performance across the world. Okay, so it was one of the best periods we ever had. But the problems of the interwar came back because we had a fixed exchange, a pegged system. But no longer is it based on gold, it's based on the dollar. It's based on the US following the convertibility between the dollar and gold, and it required the US to follow stable monetary and fiscal policies and to be credible. Okay. And it collapsed after 1960 because the US began following inflationary policies to finance the Vietnam War and Johnson's Great Society. So that's, in a sense, it collapsed because it was a pegged exchange rate, just like the interwar did. And at the same time, financial stability, looking at that, the Great Depression is blamed on the banks and the central banks, and that led to extensive external and domestic controls and subservience of central banks to the Treasury. This happened in the States, happened in every advanced countries. And so what you got financial stability, okay, but you also get the beginning of a period of financial repression, which I define as interest rates set artificially low and various restrictions on the financial sector. Okay. Then we go to the managed float, which is the regime that followed the collapse of Bretton Woods. And a big story there is the great inflation, because you cut the link between gold and the dollar and the restraint on inflation. But that means that central banks have to follow stable domestic monetary policy, and they didn't. Okay, in the 70s is one of the high, 60s and 70s of high inflation. Because the gold constraint's gone, because countries follow flawed doctrine, they start to play the Phillips curve trade-off, and the treasuries are dominant. It's a fiscal dominance regime. And central banks lost their credibility. So the 70s is a really bad macro period of high inflation. And that doesn't really get worked out until the Volcker shock of 1979 in the US, which led to a return to rule-like policies and credibility for low inflation. And then other countries followed that. And so you get the great moderation, which is a period of good macro performance. But at the same time, financial instability comes back. Okay? And that reflects, it's a complicated story, but you get, and the banking crisis problem suddenly comes back. There hadn't been any banking crises from the mid-30s until the early 70s. Okay. And that story is pretty complicated. It reflects the great inflation and controls, interest rate ceilings, the two things interacting, okay, leading to a disintermediation from the banking system. And then there's liberalization driven by political economy pressures and also financial innovation as a way of getting around the controls. And so we get the domestic controls are reduced and capital controls are removed. And so what's happening is that now a lot of pressures that I'm building up start to really manifest themselves in in banking crises. And when you have this financial safety net in place, deposit insurance and a lender of last resort, you don't get the banking panic problem. You get a banking crisis with fiscal resolution problem, which is what we have today. And then the whole idea of too big to fail and moral hazard becomes an issue starting in the 1970s in the US, but other countries too. Okay, so that leads to the last regime, which is the global financial crisis. And that story is pretty well known. I mean, I think there are three factors. US housing policy, going back to the 30s, loose Fed policy in the early 2000s, and lax supervision and regulation. That, in a sense, the regulators in the US really dropped the ball and weren't aware of the financial innovation that's going on. And that fuels a credit-driven house price boom bust and a global financial crisis. Now, we didn't get the Great Depression. Why? Because, in a sense, Bernanke knew the plot, and we did follow, the Fed did follow, and Bank of England and the ECB did follow successful lender of last resort policy. But a lot of the policies that they followed, quantitative easing and forward guidance, and a lot of the interventions that occurred in liquidity policy threatened central bank credibility and independence. Okay. And then what happened after the great financial crisis is regulation came back big time. And in a sense, in the States, it's Dodd-Frank. And in the rest of the world, it's Basel III. And the extensive regulation of the financial sector was based on the belief that the global financial crisis caused by financial sector imbalances led to a credit-driven asset price boom. And so the question I pose is this going to be like the 30s? Is this a return to financial repression? Okay. So that's my overview, history overview. And what I want to do, are there any questions about that? Oh, that's fine. Any questions? Okay. Okay. Yeah, hi, Laura. Yeah. Okay, you know, we should get that mic to her because I can't hear her.
Thank you. Sorry for the... I was just asking on the previous slide when you mentioned that unconventional monetary policy threatened central bank independence and credibility. If you could just clarify that point a little bit further. Why do you think that's the case?
Again, this is... I threw this out, but... and maybe I'm reflecting a view that not everybody agrees with, and I guess maybe because I spent a lot of time at Stanford with John Taylor, maybe where it's coming from. Yeah. But I think it's not just it's not just QE. It's a lot of the liquidity policies that were followed in the crisis, and the fact that the Treasury was linked in with the Fed. So you got fiscal and monetary linked together. That threatens central bank credibility. Okay, then QE itself involves a very large fiscal element. Okay, so and also the forward guidance story is one of moving from discretion, rules to discretion. So these are the issues that are underneath that slide, and they're in the paper I've written. Okay, so that it is controversial. And not everybody agrees, but in a sense, I think that this is a problem. Okay. Yeah.
Thank you.
Another question to the slides. You talked about credit-driven asset price booms, and I was wondering, those booms can come from credit supply or from credit demand. Are these two sources equal for you and equally problematic, or is there a difference?
There's a key difference. In a sense, the story that I think the BIS has bought is the supply side story. Because in a sense, credit demand it's endogenous. So there's always going to have the credit. So it's a story of, in a sense, excessive credit or imbalances. And I see that as primarily a supply side story. But that is a good question. And it's, it gets right at the heart of the debate. Yeah. So, okay, so what I want to do is I want to talk about financial crises, because this is the heart of the story. Like, what are they? What caused them? Is credit really a big, big deal? Okay. So to understand clearly the link between the monetary and financial policy regime and financial stability, you really have to understand the record of the most extreme form of financial instability, and that's financial crisis. I've been working on this topic since the mid-'80s, way before it became popular. And not only has the financial crisis problem returned with a vengeance in the second year of globalization since 1973, but it's actually the output losses have been rising in recent years, at least since the crisis, so they start to rival those that we saw in the interwar. They aren't as up there yet, but in a sense, so the crisis problem is becoming really big, and that's why financial stability is getting so much importance. So what I'm going to do is just show you some evidence. Okay, so first of all, I'm going to show you a couple of pictures on the incidence of financial crises. This comes from my work with Chris Meisner. We did this for a North Holland handbook in macroeconomics a couple of years ago. So what we did was we put together the databases, my database with Barry Eichengreen, and Reinhardt and Rogoff's database, Alan Taylor's database, and a database that the IMF's been putting together for the recent years. And all we're showing here is the probability of a banking crisis. It's across a group of countries, 28 countries. There's a sample that goes back to 1880, and then the recent stuff is done with a much larger panel. The takeaway from this is not to focus on the different colors, which is showing you that what you get depends upon what you put into it. And so the data definitions across the different researchers are not the same. Okay, but even if you do that, what you see is a pattern. You see that there was a crisis problem pre-1914. Okay, there was a huge increase in crises. It depends on whose data that says how big it was in the interwar. Okay, then it comes back. Then there's Bretton Woods, and you can see there's nothing. Nothing happened. There are no crises, virtually none. And then it comes back, and it's a back to the future story. Okay, now an interesting thing is that if you look at Reinhardt and Rogoff Taylor, there's obviously the previous period is more of a back to the future story the recent period than some of the other databases. Okay. But what we talk about in the paper is that it's coming back. Okay. Okay. The second piece of information that everybody looks at, and the one that gets them the most scared, is output losses. And we, in our work, Meisner and I, we have different definitions of output losses, but basically it's the gap between what real output would have done, the trend growth of output, and what real output does. Okay, we've done lots of sensitivity on that. There's a big debate about how you measure it. So what we did was we put together the different databases, and this shows you what these output losses are across regimes. And what you see is that you see a back to the future story, and you see the interwar is obviously worse, but what's most telling is the figure on the right-hand side. Okay, and this gray one is the IMF, which is recent, got lots of countries. Okay, what you see is it's coming back, and the magnitudes aren't like the Great Depression, but they're certainly a lot more than pre-1914. So this is, in a sense, the figure that explains why there's so much interest in this subject. Okay. Another thing we did was a meta-study on the determinants of financial crises. So we looked at the whole literature, and basically what we found is that there's no one factor that dominates. Okay, there are lots of things: absence of lender of last resort, poor supervision and regulation, weak bank structure, financial sector liberalization, and credit booms. And the credit boom story becomes more important in the last 20 years. Okay, but if you go back in time, it's the other stories that matter. Liberalization was a big story earlier in the post-war period. Okay. Okay, then what I do is, and I won't have time to spend a lot of time on this, but this you'll find this interesting, is I do narratives on 12 very important and serious financial crises in the past 2 centuries. And I have a table here which you can't read, but I'll put it up there anyway. So what I show in this table is I show whether whether a crisis was part of a global financial crisis. Did it affect a lot of countries at the same time? What was the exchange rate regime? Was it gold or paper? Was it a twin crisis, banking and currency? Whether a central bank was in place? Whether there was a lender of last resort that actually worked, whether it was fiscally resolved, and the type of bank structure, whether it was unit, branching, or universal. Okay, and basically what we find is that, and we look at 12 big crises going back to 1825. This record is pretty close to what Kindleberger has in his famous book and what a lot of other people have looked at. Okay. So these are pictures. So I picked out a few that are kind of cool. This is the Over and Gurney crisis in England in 1866 that Bagehot got all excited about, that the Bank of England messed up. And the story isn't a credit boom. It's a major discount house investment bank called Over and Gurney, the biggest bank, and it's mismanaged. Okay, and it becomes insolvent. It goes to the bank, says, we're insolvent, rescue us. Bank says no. Okay, because you're insolvent. Big banking panic. Then eventually, when things get really bad, the bank steps in. But there's a serious recession. The picture shows all these people standing around. That's banking panic. Okay. Second one is the Baring crisis in London, 1890. Again, now this one is interesting. It's a big investment bank, the biggest at that time, Barings. It was heavily exposed to emerging market debt, Latin America, Argentina in particular. There's a real estate boom in that country, and there's a boom, wheat boom, and opening up the railroads. And what happens, of course, is that it's Argentina, and there's a revolution and a debt crisis. They default on their debt. And what happens is Baring goes to the Bank of England, says we're insolvent. This time, the bank says, oh, okay, we're going to do something about it. They arrange a lifeboat, a rescue. They get all the other financial players in London. They put them in a room, close the doors. They say, okay, here's the deal. Got to work out a rescue. We got to recapitalize this bank. The Bank of England will backstop the loan. U.S. Treasury, the UK Treasury will backstop us. They announce the deal, no panic. Argentina and Latin America and the whole emerging market world, there's a huge sudden stop and a giant crisis and recession. Okay. 1907, key banking panic. That led to the establishment of the Fed. There's no asset price boom associated with that. Okay, it's a sudden stop of capital. This relates to Laura's paper. And where's it coming from? It's coming from Britain. Okay, there's an earthquake in San Francisco, big payout by the British insurance companies. That leads to a capital outflow from Britain, from Britain to the US, and a gold loss, the Bank of England. They raise bank rate and they ration credit against American financial institutions. And then there's a huge financial crisis in London, in New York, very famous. JP Morgan tries to arrange a rescue, is not successful, only ends with a suspension of payment. And it was the straw that broke the camel's back that leads to the establishment of the Fed. thing to note about this picture, they're all standing around, but now you see their cars. In 1866, it's horses. So we're seeing progress. Okay. And this one, the last one, is the one we all know, 29 to 33. Wall Street boom, financed by equities and bank credit. And the two policy mistakes that I mentioned, real bills doctrine and the failure of the Fed, that led to the Great Contraction. Now there are a lot of cars. Okay. Okay. So what comes out of this? The history of financial crises in the past 2 centuries reveals a lot of heterogeneity in the circumstances in which they rose, their causes, and how they were resolved. The key causes involve domestic and external shocks, weak bank structure, and supervision and failures of supervision and regulation. There are lending booms and busts, some of them, but not all. And some are driven by bank credit, but others by foreign bonds and equity flows. Okay, so the banks in some of these, the banks are a key part of the story, but not always. Okay. So the key ingredient in how a crisis played out was the presence or absence of or failure of the monetary authorities to provide lender of last resort. And in the past 2 decades, the fiscal authorities are a key player, because with the advent of the financial safety net and government guarantees, banking panics have become fiscal crises. The credit-driven asset price boom, which is viewed as the cause of the recent crisis, they were important in a few big crises before World War, but not the majority before World War II. Since the collapse of Bretton Woods and the return of financial globalization and domestic liberalization, financial instability has come back. And there has been innovation since the 1970s, and Alan Taylor and Skolarik's paper in the AER in 2012 describes that, how banks have now been able to fund themselves in financial markets and not have to rely on their deposit base, which has allowed bank credit to grow faster than the money supply, increased leverage, and it was likely a key cause of the asset price booms that occurred later. And there's been financial innovation, which led to the growth of the shadow banks, which has made it hard for the central banks to get on top of things. So that has increased liquidity and leverage and created a new source of systemic risk. Okay. So, any questions about that? Okay, so the last thing I want to do in my last 10 minutes or so is to look at some very cursory, descriptive, empirical evidence on this link between credit booms, asset price booms, and financial crises. And this is preliminary. I'm doing work with a colleague at Rutgers, 2 colleagues on this, and there are other people that are working, and they're finding results pretty close to what I'm going to show you. Okay, so there was a new perception about the causes of financial crisis, a new emphasis on the role of credit-driven asset price, and new policy prescriptions. So what I do is I ask 3 questions. What's the incidence of credit booms associated with banking crises? Do credit booms peak before or coincident with them? Second question, what's the incidence of equity boom busts, housing boom busts associated with banking crises? Do they occur before or are they coincident with banking crises? And the third, what's the relationship between these types of events and serious banking crises? That means GDP falls by 5% associated with deep recessions. And what I did was I used business cycle methods. I used the Harding-Pagan approach to identify business cycles and credit cycles. And I used, for credit booms, I used the approach of Gorton and Ordonez in a recent paper, where they define a credit boom, a good credit boom, as related to the growth of TFP, things like railroads in the 19th century or the internet today. And a bad one is one that fizzles. It just doesn't take off. And so they have an identification rule, and we followed this. and we applied this to the data that we had on asset prices. And we used two databases. We used total loans divided by GDP, which we got from Alan Taylor, which came from my own work years before, and I gave my data to them, and then they extended it. And then domestic credit to the private sector, which only covers the recent period, which comes from the World Bank. Okay. So what we do is, I have a figure here. It's figure 3. Let me find it. Okay. And that it's just a real simple ocular, regression. All I do is I look at credit booms defined using this metric, the Gorton-Ordonez metric, and major financial crises. And so the crises are the blue X's, and the credit booms are, there are two methods. There's one using banks, and the other's using total credit. They're the other colors. And so all you have to do is just look at when they line up. Okay, it's very simple. And basically what we find is that the percentage of credit boom peaks that peaked within 1 year of a financial crisis was about less than 4%, using one metric and only 2% using the other. Okay, and then these results are pretty dramatic. Okay, what they suggest is that credit boom-induced big crises, like the Great Contraction of the 20s and 30s, they're pretty rare. They happen about once every 75 years or so, because most of those lineups are in the 20s and 30s and later. Okay, so that really is the question. Whether there should be a major financial stability regime change, given that there are only two events that seem to be where this seems to happen. Okay, then I look at housing boom busts with major banking crises. Here the incidence of correlation is a little higher. It's about 10%. Okay, I then do it for stock price booms, and again, the incidence is lower. It's 3%, the coincidence. And that's kind of consistent with a lot of work done at the IMF showing that housing boom busts are much more important than stock market boom busts. Okay. Then I look at house price busts and credit boom peaks. And I find that the coincidence is about 6 to 7%. Okay. And I did it for stock prices, and it's a little bit, it's less. Okay. And the final thing we do is, okay. So what comes out of these ocular regressions is that the coincidence between credit boom peaks and serious financial crises is pretty rare. And it also suggests that the coincidence between credit boom peaks is not really that closely correlated with asset price busts. And most of the coincidence occurs in these two periods, which we can call perfect storm episodes: the Great Depression and the global financial crisis. And other people have dumped into this game. So the paper I just read by some guys at Princeton, Brunermeyer, Chris Sims, and others, look at credit booms, and they do the same kind of exercise, do an econometric exercise, and they find there isn't much of a connection with recessions. Okay, I've worked with Pierre Siklos. We've used a different methodology. We used principal components and wiring ratios, and we get the same kind of results. Okay, so that leads to the question whether these rare events should lead to a sea change in monetary policy and financial stability policy. And after the Great Depression, that's what the monetary authorities in the world thought. That gave us 40 years of financial repression. And that led to unintended consequences, okay, driven by the dynamics of financial innovation, and may in turn have set the seeds for the global financial crisis 80 years later. And a key element in this was liberalization in the 70s and 80s as a response to financial repression in an era of high inflation following the collapse of Bretton Woods. And so I'm arguing the current obsession with financial stability, and especially the use of the tools of macroprudential policy and LAW, might just raise the risk of repeating the mistakes of the 1930s and creating a new regime of financial repression which might have unintended consequences. And it might head off a few minor financial crises in the next few decades, but much later down the road might lead to an even bigger financial crisis than 2007 and 2008. And there's an analogy in this between what I'm showing and work done by Myron Scholes and Aaron Tornell at UCLA. Okay, but there's an analogy with policies to prevent natural disasters. So Scholes gives this analogy between firefighters putting out every small fire in Yellowstone Park. That leads to the growth of underbrush. There's a whole big story here, but I'm just giving, and that sets the stage for the multiple lightning strikes leading to much greater devastation. Yeah.
I just want to make sure I understand the story as you're telling it, because it seems to be the case that your story is different than the fire story. It seems to be that financial repression, people eventually get sick of it, and then they do something really stupid, which is liberalization, and that's what causes financial crisis. Is that a fair assessment, or are you saying something different?
Okay. The analogy is that the fire service, in a sense, reduces forest fires. Okay, people move in, do something stupid thinking they're safe, and then what happens is the thing gets worse, and then you have what's happening in California right now.
But if I understand the history as you're describing it, you're arguing that it's the liberalization that took place after 73 that laid the seeds. It wasn't the repression, it was liberalization that laid the seeds for the financial crisis.
So yes, that's a key part of the story. The liberalization is a reaction to the financial repression, and the regulators drop the ball by not realizing what's going on.
If they could stick to financial repression, it would be fine, but they can't. That's the problem.
That's the problem. Okay. And so that I'm saying that could happen again if you just introduce this whole regulatory framework. Okay. So, and so what this tells us, I mean, just the lessons to wrap this up is, I looked at this record of the link between financial stability and the monetary regime, and I showed you that, that this evolved a slow learning process by the central banks. Okay. And I also showed that up until the great financial crisis, there were these four principles that seemed to come out, which were sort of embodied in the great moderation. Okay, but now one thing which is just interesting, I just wanted to throw this in right now, is that the story doesn't have to happen, the story of the crisis. And again, I'm from Canada, so I always think about that comparison. So work I've done with my colleague Hugh Rockoff at Rutgers and Angela Reedish at UBC, we've done a lot of papers comparing US and Canadian banking. And Canada avoided banking crisis altogether by, in a sense, following these four principles and not deviating from them. And a key difference between Canada and the US has been sound bank structure and prudential financial regulation. Okay, so it doesn't have to happen. Okay, so the global financial crisis of 2007, and it was like the 30s, was blamed on the banks and the financial system. That led to the creation of a new regime of financial regulation and the elevation of the financial stability mat to primary importance, and to the case that's made today for elevating financial stability mandate to the same level as price stability, and encouraging central banks to use their policy tools to head off these credit-driven asset price moves. It's based on the assumption that serious financial crises are largely driven by credit-driven asset price booms and the failure of monetary and financial regulatory authorities to head them off. Okay. But the evidence that I put together and other work that's being extended on this cast doubt on this assumption. Financial crises are very heterogeneous. And moreover, serious financial crises with credit booms are very rare. And so it could be that the recent event we've had is a one-off event, a perfect storm with multiple causes, like 29 to 33. And so it raises this question of whether this event should lead to a sea change in policy like occurred in the 1930s, because that did lead to an environment of financial repression, which did provide financial stability, which set in place forces which led to unforeseen and eventually serious threats to financial stability. And it may have sown the seeds for the GFC 80 years later. So, in a sense, I'm arguing that the current obsession with financial risk recreating some of the mistakes of the 30s, 40s, 50s, and 60s. Okay, and then there's an issue of the tools. So, in addition to financial repression, the adoption of many of the tools of macro-pru that have been proposed might create some of the problems that came with the use of those tools in the past. Because many of the policies that are being advocated aren't new. They are old. They were used in the 50s and 60s, 40s, 50s, and 60s, into the 70s. And they involve the monetary authorities inefficiently picking winners and losers and influencing the allocation of resources. And they impinged on central bank independence. So there are these perils we have to be worried about. And the pursuit of such an enhanced financial stability, it may work. It may head off financial crises in the next few years, but it could precipitate an even bigger crisis than we saw a decade ago. And so what this survey suggests is that there's a connection between the monetary regime and financial stability. And it suggests that if you know economic history, that can be really valuable. And basing important regime-changing decisions on the record of the last crisis ignores the heterogeneity of the crisis problem. So history teaches us the importance of relearning the details of the events of the past, which often contain important and long forgotten clues to aid in understanding the crise du jour. Okay, so that's my story. Okay, and I do have some things to say for young economists, but maybe we'll get some questions first.
All right.
There's time.
Yeah. Thank you very much for this nice presentation. So yeah, we will open the floor for a few questions if there are any.
So, thank you for the presentation. And I wonder if you could elaborate a bit more on the financial repression, because I don't see the analogy. Because in the 1930s, when Roosevelt came to power, ideologically, he was much more left-wing than the current political ideology or current Congress, right? So the legislation that was put in place was far more repressive than Dodd-Frank. And at least I don't see in the near future, at least a Congress that would go as far. So I'm not understanding the historical analogy, or if your concern is from the macroprudential side, where does your concern from or for financial repression come?
Okay, well, actually, I mean, I'm not the only one that's talking about financial repression. Okay, Carmen Reinhart's been pushing this button too. It's not the same. Okay, so Glass-Steagall and Regulation Q and prohibition of interest on demand deposits and all the things that came out of the New Deal aren't the same. But they're, in a sense, if you look at the rule book of Dodd-Frank, okay, that's like I don't know, 10,000 pages, I forget, really huge. Okay, many, many things which haven't even been adopted yet. Okay, if they all were adopted, and for example, if Elizabeth Warren became president, there are real similarities between the 1930s. And secondly, the BIS has gotten involved heavily in this, and the Financial Stability Board. And in a sense, they've imposed a lot of regulations. And the question is, you know, is this really going to solve the problem? So I'm just raising the analogy. It's not lined up perfectly. A lot of the financial repression was in the form of keeping interest rates deliberately too low. Okay? But a lot of it was the firewalls that were created, and also a lot of the instruments that were established, the regulations that were established for the financial system. So when you do an analogy like I did, Joao, it's not that you want to make a perfect lineup, but the analogy is to the thinking that comes out of the crisis and the way that you say, okay, why did we have a crisis? We had a crisis because we had the shadow banking system, because we had this credit boom, because, and there's all this, there's a story that came out. In the US, we had the Financial Crisis Inquiry Commission. It met for just like a week, and they came up with a ton of stories, and then they did all this legislation. Okay, and it's going to take years to come out and decide what's really, really good. Okay. Well, the Great Depression is the same story. Okay, the banks were blamed, and the Fed was blamed. Okay, and the indictment against the commercial banks in the United States, a lot of it was false. It wasn't investment banking that caused, you know, that caused the crisis. A lot of it was were rules that prohibited nationwide branch banking, and it hobbled the financial system. So instead, they didn't think like that, and they didn't introduce nationwide branch banking. So my story isn't to line up a perfect analogy. It's to tell you that there's a risk. You see what happens. You prescribe things based on the fact the public wants you to do something. You do something, and then it takes decades to figure out what's really relevant.
Thank you very much. One way I understood you was that you had the developments in the 1920s, then you had financial repression. After financial repression, it took something like 30 years to build up a financially liberalized system, which then kind of or partly collapsed during the great financial crisis. So rephrasing that, you could also think about a two-regime world where you have financial repression on the one end, and highly liberalized but very volatile financial crisis prone system on the other hand, and it just takes about 30 years to get from the financial repression end of the system to the highly volatile stage at the other. If I also get you correctly, then your recommendation would be to not go to financial repression because that's bad, but to have something like an intermediate stage of regulation where you are stuck between those two extreme states. Is that true? And what sort of recommendation do you finally give? What sort of regulation should we have?
Okay, so what I would say, and I didn't say that, but what I would say, and I have said in other papers, is you can have a very, simple rules-based monetary system and financial system, and so we for the macro system, it's following something like, inflation targeting, price level targeting, what we're doing now. Okay, and for the financial system, it's having lender of last resort and, say, using something like capital. So have capital requirements, get rid of all the other stuff. Very simple, and not have this whole elaborate process. Okay, and in fact, having more capital goes right back to the 19th century when we had very high capital because we didn't have a good lender of last resort in place. So I'm not going to give you explicit recommendations, but I'm saying that, and I'm not going to get into the story of Basel I, Basel II, but I know Basel III is going to go the way of Basel II. So I'm just raising this cautionary tale, and I'll let others come up with that. But in a sense, you're right. You can thread, I believe it's possible to thread the needle between financial repression and, you know, a world of the Wild West.
All right. I think we'll stop now the Q&A, so we have time for our last part with the advice for young economists.
Okay, so yeah, I was asked to talk for a bit about advice for young economists. Now, David Levine, what he said is very close to what I'm going to. So, you know, I really liked his remarks. Mine aren't that different. I didn't hear the other guys. So, like, I've been an academic economist for 50 years. It's been a pretty interesting and successful career for me, and I learned some lessons from that experience, which I'm happy to impart to the younger generation. So the first lesson that I've learned in the research and publication game, which is what we're really in, is to cooperate with others on projects. Collaboration is really key. And David Ricardo's theory of comparative advantage applies well to economic research. And I'm a monetary financial historian and a monetary I've often worked with other scholars. In fact, almost all my work, not all, has been with other people. And I work with people that have different skills than me. I work with macroeconomists, econometricians, and experts in finance. And I've been really fortunate in finding amenable and agreeable collaborators whose strengths complement mine. And the collaboration in research has really changed a lot, become more important since I started in this game. I mean, in the early years, joint papers were pretty rare, and they were discouraged. And I just remember at the University of Chicago in the 60s, it was like if you wrote a joint paper, it was really downplayed, and you got half credit for it. Okay, but as economics has progressed as a science and become more complex, it's followed the path of hard sciences, where most articles have multiple authors. And when you do collaboration, it's important to be flexible and not follow ironclad rules about who should do what. And in my experience, some papers require a bigger historical, institutional input by me, and others, it's the macro model is the key thing, or the data gathering, or the econometric estimation. And so if you get into this game of, okay, you're going to do 20%, you're going to do this, it's not going to work. So you have to be flexible. Okay, and the key thing that I found to get a paper, especially in economic history, into a good journal is a good story, a story that is unique. Okay, and what I found is that as time goes by, that the econometrics and the model becomes obsolete. Okay, it was great at the time, and you needed to do that to get it published in a good journal. But the story, the data, and the bottom line, if they're original, endures for a long time. And you see this in citation count. So I did a paper in the 90s with Hugh Rockoff called The Gold Standard as a Good Housekeeping Seal of Approval. Okay, it got probably more citations, one of the largest number of citations in economic history. Okay, we look at that paper today, you know, we looked at 9 countries. Today people look at 30. Look at the econometrics we did. We did everything. It's all been condemned. Okay, they look at this and they said undergraduates wouldn't do this bad. Okay, but back then it was actually pretty good. So, you know, but it's the story that came out. My second piece of evidence is to work on projects that you really have a passion for. I think this is obvious, and I think David said the same thing. And also, I've always worked on projects that have a public policy perspective. I've always been interested in doing something that's relevant for now, for policy. And actually, when you do papers like that, they do have an influence. They can influence policymakers and the press as well as our profession. Okay, my third piece of advice is to diversify and work on a number of projects at the same time. I've found that scholars who slave away on one paper for years, hoping to get it into a top journal, and I'm qualifying this unless you happen to be a child prodigy who spent your whole life in the Ivy League, and there are people we can think of like that, that's often going to lead to disappointment at the hands of, quote, perceived to be unfair referees. Okay, so I found that if you have a number of papers, irons in the fire at the same time, the chances of getting papers published goes up. Okay, also it deals with what I call the JME problem. So I'm a macroeconomist, and I've been publishing a lot in the Journal of Monetary Economics. I've published a half dozen papers there. The average time from first submission to publication was about 3 years. Okay, and most of that time reflected not me, but the delays in getting referees' reports, and even worse, the editor making a decision. Okay. In my university, a number of people, macroeconomists, junior, didn't get tenure because of this problem. They had about 4 or 5 papers, and they didn't get accepted, and they didn't get tenure. Okay, so this is a big deal. Also, when you get a paper rejected, my philosophy is you first get mad. You get mad, you blame the referee, you know, the whole bit. Get depressed, I'm going to quit, you know. Okay. And then I put the paper aside. I just put it somewhere else for a while, a few weeks, a month. Then I figure out which referee suggestions are really worth taking on board. And then if I think they're really good, and I talk to other people, or if it's co-authors, it's a lot easier because you can talk about it. Then you revise the paper and you send it to another journal. And sometimes you just say, you know, I might not ever see the same referees, and you just turn it around and send it to another journal. So my fourth piece of advice is to network as much as you can without cutting into your productivity. Go to as many conferences in your field as you can get invited to, and especially aim at high-level conferences like at the NBER in the US or CEPR here, or at central banks. I think this is the best way to meet other young scholars and to signal your work to more senior scholars. And also, again, pretty obvious, try to put your papers out as working papers that have high visibility. And today we have blogs and we have other electronic media, and the press, high-level press, Wall Street Journal, Financial Times, Economist, they're pretty good ways of getting your work known. And VoxEU, which I've used a lot, is really good. It's terrific in terms of getting visibility. Okay, my next point, which is related to the last one, is to try and present your work as seminars at research universities. Because if you get an hour and a half seminar where all the participants are just focusing on your work, that can really lead to major improvements. In conferences, you get 20 minutes, you got to discuss it, and then you move on. But if you can get invited to good places where there are good people and they do actually pay attention, this can be a real game changer for you. And then related to that, you should solicit advice from senior scholars and experts in your field and be willing to accept their advice and criticism. You have to have a thick skin to survive in this journal publication game. So if they criticize you and say this is really bad, you should go back to square one. Okay, your first attitude is the hell with you, but actually they may have something that you could learn from. A next point, which is really relevant more because I'm an economic historian, is that writing books is really only a good idea for an economist if you're probably an economic historian too. Okay? So, or you happen to be in a department, some department that values books. There are some places, Stanford, for example, values books, especially for economic history. or if you already have tenure. Okay, but saying that, I mean, research monographs can be really durable in the sense that they have a long citation half-life. And of course, if you write a big think book that can make you rich and famous, like Piketty, that's terrific. But you have to have a research track. You have to have a research track before a prestigious publisher, you know, like Cambridge or Princeton or Oxford or Chicago, is going to take you seriously. Okay. And then another point that I want to make is when you put together a new database, okay, this is really important. Do not give away the family jewels to people who ask for your data. Okay, you wait until you have some kind of copyright, either in an accredited working paper series like NBER, and it says copyright, or a publication in a referee journal or in a book, but somewhere where there's something that says it's yours. Because people will use your data, and they may or may not give you credit for it in their publications, and then it goes into the public domain, and you're totally forgotten. And this has happened to me. It's happened with financial crises, with macro stuff. So I'm just warning you, because when you do something really cool, and you put it out on the web, and there's this paper that comes out, and everybody says, oh, this is great, can I have your data? Okay, and you feel flattered that they want it, don't give it to them. Just say, look, I'm just a junior scholar, I want to get established. Okay, when I know it's published, then I can let you have it. Okay? And finally, in terms of your career, and this again is obvious, a good strategy is to be willing to move to other places if opportunities arise, to be flexible. And moving to a better university is usually better. Okay, usually, because sometimes the new culture may not work for you, and you may not like the people that are there, or just the stress. Okay, and outside offers generally give you more leverage in bargaining on your salary and working conditions with your present employer. And so to make this happen, of course, you should try to be as productive as possible and have your work as visible as possible. Okay, so I mean, this is the way things are done in the US. Okay, that's the culture. Other countries, it's harder. There's a lot of emphasis on loyalty and all this stuff. But I'm just saying, you know, you shouldn't just rule it out. And so when you get a job and you get tenure, say, this is it for life. I can wait 40 years and I retire and I get my pension. You should always be thinking of options. Okay, so that's my advice.
Thank you.
Okay. Yeah.